So if we start off looking at gas fundamentals, at the moment the system's really oversupplied, really comfortable, and that's partly due to really strong LNG flows that have continued over recent weeks. But on top of that, we're also seeing strong Langled flows. So Langled is a pipeline that connects Norway to the UK. And basically at this time of year, we'd typically expect to see around 15 MCM worth of gas flows. We're seeing close to 40 at the moment, so that's a significant increase versus kind of what's typical for the time of year. And that's basically leading to a really oversupplied system. Going forward, this might not be the case, as we've got maintenance booked in from the 27th of May until early June, and that's expecting to have an impact of around 140 worth of MCM to Norwegian production. So that's not all coming to the UK, it's to the UK and the continent as well, but that's expected to have an impact on Langled flows, and they should drop to around 10 MCM. Now moving to power, we've basically seen over recent weeks a very variable wind forecast. Early this week we're expecting to see a wind increase, which will obviously increase renewable generation and potentially dampen prices. On top of that, we've also seen a lot of nuclear maintenance over recent weeks, but most of that's finished now, so we're seeing nuclear plants resync to the grid and capacity increase generally, which should widen supply margins. Finally, looking at oil fundamentals, over the short term we've seen a lot of production go offline. So there's been the Canadian wildfires that's obviously impacted Canadian oil production. There's been militant activity in Nigeria that's seen kind of around 800,000 barrels worth of Nigerian production go offline. And also we've seen continued kind of unrest in Libya, which has also impacted production. Now, despite all of that, we're still seeing an oversupply on a daily basis in the oil market, which isn't necessarily being reflected in prices because there's so much uncertainty around these unplanned production cuts. But going forward, we're still seeing really strong OPEC production, really strong Russian production, and over the short to medium term, we're still expecting an oversupply in the oil market going forward. So we started off looking at gas prices. So short-term contracts relatively close to delivery have fallen this week, and that's linked to the fundamental changes we've already talked about. So the fact that we've got so much gas coming from Norway, the fact that LNG deliveries are so high, it's basically suppressed gas prices over the short term. If you look at power prices, the fact that gas has got cheaper, that has a knock-on effect on power, as well as the fact that we're seeing increased renewable generation and all these offline nukes have come back following the end of maintenance. That's basically seeing supply margins widen and having a knock-on effect in terms of dampening power prices. Now, if you look at seasonal prices, over the last few weeks they've traded relatively flat. However, the losses that we've seen to short-term gas and power contracts, basically since seasonal prices also stepped down away from that sideward range. Looking at oil prices, they've continued to gradually climb. There's obviously peaks and troughs on the way, but at the moment they're finding significant resistance below the $50 per barrel level. So we've not managed to push up through 50 just yet, hovering around 48, 49. And given the fact that the fundamentals still remain, favourable over the short term, there's potential that we're not going to push through that over the immediate short term. Given that prices have moved away from contract lows seen earlier in the year and haven't shown necessarily signs of getting back to them over the short term, now might represent a good opportunity for customers to place fixed price contracts. Although the market isn't at the bottom of the market anymore, if you look at it in this terms of the last 18 months to 2 years, we are largely at the bottom of the market. So if you entered and placed a fixed price contract now, you'd be achieving an almost bottom of the market price. For flexible contracts, again, it's down to attitude to risk and your current hedge level. As we've mentioned, we are almost at the bottom of the market, slightly missed it over the last few weeks. However, if you've got no hedges in place whatsoever, this represents a good opportunity for you to increase those hedge levels. However, there is a strong argument that prices could decrease going forward. So if you want to maintain some exposure, that's great. You're potentially going to benefit from that over the short to medium term. Those customers who've already got hedges in place might not benefit from taking any further hedges at the moment, given the fact there is uncertainty. Prices could go up and could go down, and that's linked into your attitude to risk. If you are prepared to chase the lower prices, then maybe sit on your hands for now. However, if you're looking at market prices and seeing a year-on-year saving, it would definitely be worth your while entering the market and maybe increasing your hedges a little bit more.